and go ahead.
Okay, guys. Hello, everyone, and welcome again. Hello to the webinar, Mind Matters in Making Money. We are really happy to see all of you here. And actually, we congratulate you for participating in this webinar because the psychological side of trading is a really deep ocean and it's only for the brave. So to start with, let's first present ourselves. My name is Rada, as you already know. I got my bachelor degree in psychology this year. Therefore, I participated in many webinars and workshops for skills developing and optimal performance. However, this is not my one and only professional field. Right now, I'm working in a multinational fintech company in the sphere of compliance monitoring, and I have some experience in trading financial assets.
And I'm Daniel Chutrov. I'm a psychologist and psychotherapist. I work with people one-on-one, but not only. The most important thing is that I used to be a professional poker player in the past, and I have coaching experience in poker and a lot of interest in optimal performance in all kinds of areas. As a poker player, I turned $50 into close to $500,000 at one point. After that, I lost like 50% of it due to mindset problems and mental game issues, which are very similar to the kind of problems that cause losses in trading. So as a poker player, I had like 4 or 5 figure swings on a daily basis. So I'm confident that I can provide you with a lot of insights into the psychology of trading and dealing with losses, especially. Now I work with normal people, but also with poker players on the psychological and mental game side of things. I'm also doing group therapy workshops that are complementary to the individual one-on-one work that I do. And now Radha will present you with the topics of the webinar today.
Okay, guys, so as you probably already guessed, in today's webinar, we are going to review some aspects of our psychology that are inevitably connected to and influence our trading performance. As a start, we are going to put our attention and focus on the source of some of the most common trading mistakes arising from our psyche. Next, we are going to take a look at the way our conscious and our unconscious mind can sabotage us while we are trading and how they can sometimes prevent us from consistently making profits. And for final, we are going to put special attention to the way we perceive risks and specifically how sometimes we take risks that we actually haven't accepted, which means that we were not prepared mentally to lose, even though the possibility was there while we was taking the risks.
Okay. So psychology and trading, why is it important? Because psychology is everywhere. As a start, you can have in mind that everything we do in our life is influenced by our psychology. Every decision we make, what to eat, what to wear, who to date, who to marry, what position to take on the markets. So psychology and biology influence every one of our decisions. And what does our psychology consist of? Well, many things like motivations, emotions, beliefs, habits, common thoughts that we have, and others. And here, importantly, we are not talking only about our conscious mind that influences our decisions, but also our subconscious mind. And that's very important. So, our unconscious motivations, habits, fears, etc., that we sometimes don't even realize that exist, could strongly influence our trading behavior, usually in a negative way. They could operate like a force that we cannot see on us. So when we talk about psychology in trading, we are going to refer to the emotions and the mental state that are related to success or failure in trading, to making mistakes or making the right decisions. Actually, trading psychology is important because every trader brings into trading various aspects of his character and behavior that he has in his life that influence his or her trading actions. We're going to give some example later. And as we go forward, you're going to see that trading psychology is as important as other attributes such as technical knowledge, just a second, such as technical knowledge, analysis, experience when it comes down to determining success in trading. And as people say, a person's chief problem and even his worst enemy is likely to be himself. So, Radha, could you please take it from here?
Yeah, now guys, going to the main point, let's look at the psychological side of mistakes, or how our psychology and our mind specifically could be related to some trading mistakes. Basically, as you perfectly know, making mistakes while trading is part of every trader's journey. And whether someone is completely new to trading or has been trading the market for decades even, chances are they will still make some common mistakes. And some of these mistakes are more costly than others. And the fact is, there are some mistakes that are hard to accept. Anyway, as we said, making mistakes is part of everything, and important to be aware of these mistakes, to not ignore them, but instead analyze and learn from them. And that's why we want to take the time to look at mistakes and build some good understanding for them that will help you to be better on the field of the Forex market. So trading mistakes, most of the time, they come from us. It's not the market. They don't come from the market due to, let's say, force majeure circumstances, but simply because of our actions. For example, because of lack of knowledge, let's say. So on one hand, these mistakes can stem from not knowing what one should do. That could be lack of technical analysis, lack of technical understanding, lack of fundamental analysis, or etc. But on the other hand, even if we did everything perfectly regarding the technical side, before making a trade, there is still room for failure, because trading has another very sneaky aspect. And it's that it's not only about knowing the right decision according to your strategy, but also executing upon it. And the biggest problem with the second type of mistakes is that you can always rationalize or justify these mistakes and the following losses from these mistakes with the market, you know, like with force majeure circumstances, as we said, with sudden unusual trading volumes, with information that got out at the wrong moment, with something that you have seen on the markets, and all these things you can use as excuse. And whatever external reason we choose to justify our actions in moments when we didn't follow our strategy, the truth is that we were unable to execute the right actions and to take the right decisions. And it's not the market nor the volumes, it's just us. Mistakes of these types are a lot harder to eliminate, and they are a result of our psychology, of our mindset. And these mistakes include every kind of emotional trading and guessing games that go against our strategy and its rules of engagement, like taking too big risks, or chasing losses, or revenge trading, or not cutting the losses early enough, or not taking profits systematically. Now, guys, yeah, thank you, Dani. Take a look at this slide just for a couple of minutes. Of seconds, not minutes. Minutes is too much. We're not going to make you raise your hand if you don't.
Let's leave some time, people, just to look at it, read all the things, because it's important. Everyone to account for himself, some of them. Just a minute, maybe.
Yeah. Okay. And yeah, if you're ready, guys, you can just write in the chat so we can know that you're ready. Okay. So there is a brave guy that is.
Yeah,
okay.
Everyone that wants to admit can join the chat, or just do it for himself.
We was thinking to not make you raise your hand on any of these. But anyway, let's be honest, everyone that has ever traded has done some of them. Even David. Okay, also Nikki. Okay.
Yeah, it's not very easy to admit that for the mistakes we have done, and we often try to excuse them or rationalize them, but that doesn't help us in the long term. So it's better to admit and try to learn and get better next time. So, okay, thank you guys.
A lot of brave guys in this webinar we have. Okay, guys. So as you admitted that you've done all of them, maybe you also perfectly know that when we engage in any of these activities, we enter the kingdom of gambling. And this for sure is not trading. And in the long term, it's not going to have positive and stable results that we want to achieve. And so I guess that you perfectly know that stop loss and take profit are two key ways according to which you plan your trading. And if you don't have such, or maybe you have such, but you're not executing them, then you're only thinking that you're trading, when in reality you're gambling, at least some of the time. And gambling in its core means making decisions on the basis of momentary states of your mood, of your emotions, even of your nervous system on a biological level, which automatically affects your profits, because the market, as you perfectly know, doesn't care about neither your intuition nor your emotions.
Yeah, and now here comes the big questions. Why do we make such mistakes? Why do we just not follow our strategy when it seems so easy to just execute it? Why does that happen? So to answer this question, we have to introduce the concept of mindset. Mindset is intrinsically related to psychology. When we refer to mindset, we are talking about the set of beliefs about a certain domain or area that we hold and that guide our thinking towards certain expectations, explanations, and goals. Simply said, mindset is a basic belief about something that forms our attitudes towards the specific thing, influences our perceptions, and predetermines our experience, and also navigates our actions. We have many mindsets. We actually have some kind of mindset about everything in life that we care. For example, about work, or about making money in life or in trading, mindset about marriage and relationships, mindset about medicine or what is healthy, about business, sport, or any activity that we care. Our mindset about something reflects our attitude towards it, the way we process information, and therefore the way we see things in the world. It predetermines our experience, as I said, so it impacts our decision-making, and therefore it influences our actions. So when we are trading, the mindset that we've built regarding trading is inevitably influencing the way we trade, the way we react to everything that is happening on the market, especially to losses and gains. So it's important to be aware of our mindset, and in the case of trading, of our core beliefs about the process of trading, and especially more tricky, our subconscious attitudes toward trading and our relationship with the market. Just a second. So now we're gonna check out the mindset that underlies trading mistakes, the common problematic mindset and its components. So as we said, a mindset consists of beliefs about a certain thing or topic. And let's get specific and analyze and understand what's the problem with all of the behavior that we saw a few slides before here. So there is usually an illusion. We subconsciously believe incorrectly in an illusion that we can know or predict with 100% certainty or accuracy what will happen, and that we are infallible, that we cannot make mistakes, that we are certain about something, that we can predict with complete certainty. And actually, nobody can do that. So this is just an illusion, an incorrect belief. But not only do we think that we can predict, but also our desire for certain outcomes bias our perceptions, it skews them and the interpretation of information, and therefore leads us to not following our trading strategy and rationalizing the actions of not following it in some way. It makes us justify our wrongdoings on the market with external factors. We already have mentioned some of them, like force majeure circumstances, unusual trading volumes, surprising information that got out at the wrong time, or something else. So most of the trading mistakes are a result of incorrect mindset that the person knows, and it's possible to know with certainty what will happen on the markets, or that deserves to win, has an entitlement that should win, or that is infallible and not possible to be wrong or to lose in a certain deal or position, that can analyze and predict perfectly with 100% accuracy what will happen. That sounds crazy, right? Maybe now you even think, what the fuck are these people talking about? This is not me. I don't believe any of this. And before you leave the webinar, because you think we are crazy, give us a chance to present you with the concept of conscious mind and unconscious mind, which Rada will do in the next slides.
Okay, guys, so what's the difference between conscious and unconscious? I guess you have some understanding about it, but let's make it clear. So conscious includes intentional mental activities and language. Therefore, it's responsible for operations that are intentional and require conscious effort and thought. For example, every time when you were staying at school and the math teacher gave you a mathematical equation and asked you to give an answer for this equation, you use your consciousness mind. And it was your conscious that was making it possible you to give the answer by using resources as time, effort, logic, thought, and etc. On the other hand, our unconscious operates automatically. You know, it's like the opposite of the conscious. It's really quickly, it operates with little or no effort and no sense of voluntary control. And it's our conscious mind, unconscious mind, that is responsible for our automatic models of acting, of behavior, you know, perceiving, interpreting, thinking. Where is the actual danger for trading? And to make it more clear, imagine that every time you're driving your car or every time you're riding a bicycle or brushing your teeth, you don't put a conscious effort to think how I should do this thing. You know, you never stay in your car thinking how you should press the pedal of the gas or something like this. It's just happening really automatically without conscious effort or thinking about the process. So now, after we have a clear understanding of conscious and unconscious, let's refer them with the common problematic mindset that Daniel just talked about and see the reason for it. So, as you can already probably guess, the driving force of this problematic mindset that influences also in our decision making are our core motivations, beliefs, fears, emotions, insecurities that could be both conscious and, more importantly and more dangerous, unconscious, because there is where the real danger for trading is hidden. And to understand better the way our mindset is influenced by our unconscious fears and motivations, now Daniel is going to show you some examples of trading mistakes and explain you really clearly the source of them.
Okay, so first of them is forcing trades. That's very often one of the most common mistakes in trading. Excessive trading, engaging in deals that, or opening position or closing positions that we normally wouldn't do. So let's analyze what's happening there. Why is this happening? Well, there is a couple of options. Maybe there is underlying strong desire to win or to dominate or to assert myself, or desire to prove myself to myself or to others, desire to win so that I can feel good about myself as a winner, as a successful person, or maybe to gain respect and liking in the office or among my peers or among trading community or something like that. That's some of them are one possibility. They're really close to each other, linked together, but maybe it's pure result orientation. Maybe you need money urgently and you have a desire to earn money easily or quickly. So in any case, you take actions according to these motivations to achieve them. So you start forcing trades. Well, what's happening is that we are trying to satisfy our basic needs in the first example. Some of our basic needs is feeling good about ourselves, or gaining respect or admiration, being liked with trading. So, but that leads us to not follow our optimal strategy, and we make mistakes. So that's one of the possibilities underlying this kind of behavior and type of mistakes. Another scenario that we're going to look around is chasing losses. So let's analyze when we chase losses, what's happening. Well, there is some unwillingness to accept losses and desire to get the money we lost back. Why? Well, maybe we're equating loss with failure. So when we lose, we experience ourselves as failures, as someone that is not worthy or not good enough or inferior in some way, which causes us pain and suffering. So we have a desire to alleviate this pain and suffering, to believe that we are better. So we try to win at all costs, try to make our money back, and we start chasing losses because of this activation of fears that we are weak or failure or loser. So as you see, our basic fears, insecurities, beliefs about us and about the world, our character traits, our typical behavioral models, all of these are part of us, and they carry over in our trading behavior and influence it often in a negative way. Radha?
And no matter how great a market analyst you are and how good you understand the market, if you have too many psychological difficulties, issues, and barriers, then you might not get the desired results, and you won't be the best trader that you could be. And as we said, the trick is that all of these motivations and fears that influence us could play out subconsciously, as Daniel explained, below the level of our consciousness, meaning that they are out of our mind's conscious intentional operating and normal awareness. And that's where the danger for profitable trading is hidden, because we can be acting upon a lot of motivations that go unexamined and we're not even aware of them. So part of our trading decisions could be based on mindset that is rational and optimal for the results we want to achieve on the market. And that leads for sure to deviation from our strategy. And it's no wonder that often we are not acting consistently, both in life and when trading. The two things are related. Like if you want to win or earn too badly, if we want to never lose, or if we are equating having a losing trade or even a losing day or week or even a month to being a failure in general and not being good enough, then we could be up to for a lot of trouble when trading. And it should be pretty obvious why this is the case, but let's explain anyway. These motivations and fears will push us toward violating our trading strategy and rules, and so that they make our trading emotional, and so that we can achieve the desired state of feeling okay with ourselves, often at the cost of actually losing money. Anyway, guys, unconscious mind is really a long story and a deep ocean that we're going to dive in more details in the course that we prepared for you, because there is a lot to be discovered there. Now let's focus on something else, the risk, and how sometimes in everything in life, and especially and for sure in trading, we take risks that we initially didn't accept at the price we could possibly pay for. So those two things, taking risk and accepting the risk, looks really similar, but they're kind of really different. When we take risk, this doesn't necessarily mean that we have accepted it. Taking the risk is only about making the action that brings the risk, while accepting the risk is something on a different level. It's like another story. Accepting the risk means that you're performing an action that brings some risk. You totally understand this risk, you're totally aware of this risk, and you're totally okay with it. And you're also okay and aware of all the possible outcomes that this risk brings. So now Daniel, as a professional poker player who took a lot of risks, is going to explain you in depth the psychological gap between taking and accepting the risk.
Okay, guys. So there is a big difference, as Radha pointed, let's first think about the fact that the bigger the risk we take, the more the results become important for us. Therefore, the more emotionally dependent we are on these results. This leads to distortions in perception of the information and also to emotional decisions, which lead to wrong actions, which lead to losses. So the bigger the risk, the more emotionally engaged we are, and the higher the risk to make emotional decisions and mistakes. This brings us to other point related to the fact that if we experience losses as too painful, then it means that we are not actually accepting them, and therefore we have not accepted the risk that we took. So as you see, there is a big difference between taking a risk versus accepting it. And just because you participate in something risky doesn't mean that you accept the risk. And just because you put in a stop loss or took a certain position doesn't mean that you accept the fact that the trade may turn out to be a loser. There is a huge psychological gap between taking risks and accepting the risks. But how to understand if we are accepting the risk that we take? It's actually very simple. If we have intense emotional reactions when we lose and when things don't go our way, then this means that we haven't really accepted the inherent risk, but we have just taken it. If you have resistance to execute some part of your strategy or plan, then there is something that you don't accept. If there is fear, then you don't accept 100% the risk. Of course, very few people do that, especially in the beginning. That's why trading is very similar to poker, and both are very difficult endeavor. On the other hand, when you really accept the risk, this changes everything. There is no more need to control the reality or the market, to be right about everything, to know what is going to happen, to win every single time or not lose every single time, because you accept that the undesired outcome could eventually happen any moment, and you're prepared for it. That's why the best traders trade with very little or no tension and fear. They can walk away from a trade and change something when they see it's not working. And they can do that without hesitation, without it causing them emotional discomfort or making them lose confidence or equanimity, without it touching their ego, because they accept that nothing is guaranteed and anything can happen, and therefore they are not emotionally dependent on the outcome, so they perceive the information more objectively than the other people. Therefore, there are less hidden forces operating on them and influencing their decision making and the execution of these decisions. When you're not afraid that you might lose or that things could not go your way, then you're not burdened by unrealistic expectations of what will, might, or should happen. You see things more objectively and therefore execute correctly with fewer mistakes, which inevitably leads to better results. If in a trade you're scared of the consequences, what will happen, that you might lose, then you better think about it and work with what is happening inside of you, and particularly the fears, because your fears will influence your perceptions and actions so that you act inappropriately or inadequately. Which brings us to the problem of not perceiving objectively information that differs from the convictions regarding the market movements that we have already made. And that's related to some cognitive biases that we'll review in the first of the lectures in the course. Also, when it's too important for us that the market goes a certain way, when this does not happen in our favor, we experience it as emotionally painful as a result. So that's a big problem. The hard part of accepting the risk arises from the fear of admitting that we can lose or we can be wrong because of the fears and insecurities that we associate these things with. For example, experiencing ourselves as failures, as stupid or imperfect or not good enough, etc. And when we trade, we face these insecurities and fears all the time. So these natural tendencies of avoiding mistakes and losses get in the way of our trading, because in trading, as in poker, losses are inevitable. They're just part of the game, no matter how good you are. You have to learn to think in a specific way so that you accept the risk. This is probably the most important skill, because the overwhelming percentage of mistakes come from our beliefs and attitudes towards trading, and especially towards losses. Particularly, our fears of being wrong, being a loser, missing out on a profit, or leaving money on the table. So, if our actions, the way we trade and react to losses, indicates that we don't fully accept the risk we are taking, we should definitely examine the underlying psychodynamic of these occurrences and how they're sabotaging us, which will be discussed in more depth in the optimal trading performance course. So now Radha will tell you some of the other stuff. You're muted.
Sorry, now it's okay. Just for final, we wanted to tell you that all these things, all the things mentioned in this webinar are part of each of us as humans. And we should not look at them as something bad or something scary or dangerous. They're just like opportunities to discover more about ourselves and getting better in trading. And this is possible by understanding the core of our motivations that drive us to act, the way we think, and more specifically, the mindsets that help us to the way of success, and the one that set us back from being our best version on the market. We have only touched the surface of the psychological aspects of trading. This is only the beginning, and our mind is like a really big ocean that takes time to be discovered. And that's why we prepare a special course to arm you with everything you need to know to perform better and better on the Forex market, achieving better and better results.
So guys, if you want to dive into the ocean of psychology and trading psychology in particular, and become better at trading, come to explore these and many other topics in the full interactive course that we have prepared, Optimal Trading Performance. Soon there is going to be information on the website of the 5ers, but we can tell you that it consists of 5 lectures in 5 consecutive Sundays, starting from 22nd of May until the second half of June. So every Sunday. Radha?
We want to thank you a lot for participating in this webinar, for your time, for your attention. We hope that we brought up your awareness of some of the psychological sides of trading, and that we will see you in the full course. Here on the slide, you can see that we left our contacts in case you have any questions regarding the webinar. Actually, maybe there is going to be also time now for questions, but also you can write to us if you want to say something or you just want to chat regarding psychology. And for sure, we want to say a big thank you to all the 5ers team, and especially to Jill and Saul for their trust, for their support, for their feedbacks, and in general for making this webinar possible. Thank you, guys.
Okay, thank you, guys. So now we are going to scroll through the chat. There were 1 or 2 questions, and maybe if you have more questions, you can write them down now, and we'll look them in the order.
If you want, I can read you the questions. So
okay, sure. If you find them first.
Okay, there is, just a second. There is a question from Florin. He wants to know how he can avoid the tilt mode. He's tried everything: gym, cold shower, punching myself.
Don't punch yourself, please. So yeah, that's a big problem, and it appears also in trading, both in trading and poker. Well, you should examine the underlying motivations and psychodynamic, the underlying emotions that comes up. For example, why do I experience loss as painful? Why do I get angry? What's the pain underneath? the anger, because underneath anger there's always some pain. So what does happen when I lose? Maybe I experience it as a confirmation that I'm not good enough in life or in poker or in trading, or that I'm a loser, that the other guy is better than me and I'm inferior, or that I deserve to win because I've worked on it, but I've been unlucky, so that triggers me. It could be other things as well, but it's some kind of emotional stuff like that, basically. So yeah, you should explore it either by yourself or by questioning it down, or working with a specialist, especially therapist. This is what therapists usually do. So yeah, if for a long time you could not get grip on it, then might be good idea to search for help.
There is a question for Michael where he can get this sticker. Just write me on the email. I'm going to send you every sticker you want from the presentation. Will the recording be available? Yes, I guess the recording will be available. Tips on avoiding tilt. Daniel just explained. Maybe if you want to add something that you...
Well, yeah, I can add something that relates both to poker and trading. If losses are kind of too painful for you, maybe it's about too much money, at least emotionally, at this point. So you might try playing lower stakes or betting on with smaller percentage of your bankroll, or trading with smaller amounts, so that you get used to accepting losses more easily and train yourself to not be a big deal, and then gradually move up the stakes, both in poker and trading. If you have too much pain when you lose, then yeah, you should either lower the amount you're betting or work emotionally with it, or both.
Okay, there is another question from Ahmed. How we can stabilize our emotions toward over trading? For example, opening many positions at the same time in one direction. I guess about the excessive engaging in trades.
Well, we should have stable rules. Maybe you can say a few words. We should have stable rules of engagement for, yeah.
Maybe it's better so to poker, because I see the guys are really interested in your experience.
Okay, I'll tackle it. Yeah, for first you have to have a limit, maybe one position or two or three at the same time. You should have some maximum, and then you should try to stick with it. And because it's different if you have maximum and you cannot stick to it, or if you don't have certain rules and you just do it on feeling, in feeling mode. That's one thing that's more mechanical, and the other side is the inside part, the emotional side of the things, where basically, yeah, you should work emotionally with whatever feelings comes up, anger or disappointment or frustration, and what's underneath them, and why is this happening, what's the psychodynamic. So yeah, there are some, as we presented, there are some cases that are pretty universal, but still there is individual component as well. And so I was thinking about something else as well. Also, you should have regular breaks. Maybe don't trade every day, or engage in some certain number of trades, maybe 10 per day or 20 or whatever the number is. And then after that, you stop and you enjoy your day. You try to restore yourself. You engage in some other activities that help you chill, relax, calm down, to restore your mental stamina. Because if you trade or play poker nonstop, then you get exhausted and you become more emotionally unstable. These are some things that we're gonna mention, and some fixes and some lifestyle practices that we can engage I think in the 5th part of the course. So yeah, it's the name of the course, Optimal Trading Performance, is not by accident. We're gonna talk about both psychologically, but also as a habits and biologically about what we can do in order to perform better.
There is another question. Are there exercises to better our mindset or being aware of these areas of concern? Yes, there are a lot of exercises. Meditation is one of these exercises. There are a lot of guided meditations also in YouTube, but you can work also with specialists on this. Also, another thing that comes to my mind is to practice self-reflection, to be really good in observing yourself, the things you think, the things you feel inside you, and to what actions they bring you. And maybe Daniel, you want to add something because
we can add that we talk a lot of we have because the course is very interactive. So the course is very interactive. So we have some exercises for that we give homework for the people after the lectures. So have that in mind, and we hope that we'll see you there.
Okay, another one that maybe you can also refer really good to poker. What factors causes traders open trades with big lots to quickly pass? I guess they're talking about the challenge of the 5ers, like bet big.
It's a challenge, so people like challenges, and especially men are a lot more competitive, so they try to compete and get ahead, but sometimes that leads to bad habits. So it's a trade-off, and it's important. That's why it's important to have in mind what's your long-term goal, and thus your actions today are in synchron with your long-term goals, and if not, maybe change them.
Yeah, in general, leveraging your positions could also be related to the want to achieve the results faster. And
okay, Nikki, yeah, you're I think on average men are a bit more competitive, but there are women that are a lot more competitive than some men. So it's like it's like normal distributions that overlap, but on average men are a bit more. I think that's that could be find out. Okay, well, I guess that is from us guys, so we hope that you've liked what we spoke about, and that you find it useful. So yeah, if you find it valuable, and you can engage in you can sign up for the full course, and see you there.
Yeah, guys, and there is going to be a recording, so because there are a lot of questions regarding this. So yeah, thank you guys a lot for your attention.
Bye.